Welcome to Punch Card Investing, a weekly show dedicated to all things value investing. Whether it be analyzing companies, pitching ideas, or discussing moves by the best investors in the world, we're trying to get one step closer to punching an investment off of our cards. Let's get started.
Thank you again, Intro Man. All reliable. He never ceases to produce. And it's a good way to start yet another Best Ideas episode, a follow-up from last week where we had a less than stellar turnout. Just Chris and I held down the fort, but I think we did a pretty good job. We'll see what the people thought about it. But we talked about some best ideas, and we thought we'd continue that here now that we got 4 people rather than just 2 to continue looking through some potential stock ideas. So that's what we'll have to look forward to today. But before we get into that, be sure to smash the like button, smash the subscribe button, and to comment whenever you can. If you're in the chat, let's say hi if you haven't already. We already have a lively chat with quite a few super chats as well already. Before we even showed up, Luis dropping in a couple super chats, as well as Tunisium dropping some super chats. We appreciate it very much. For whatever reason, you guys throw money at us. It's a lot of fun. It makes this a lot more fun.
I get strippers over here.
Yeah, I get the appeal. But also check out all the links in the description while you're at it. Another way to help the channel is to try those affiliate links. You actually get $100 off of a Seeking Alpha subscription. So if you check that out using our link, that's down there. We also have a discount link to ShareSite where you can do your portfolio tracking and pretty much everything having to do with portfolio tracking there, and also currency fluctuations that might affect your holdings depending where you're investing from and in what currencies you're investing in. So that is another nice tool. We got a discount link down there too. If you use either of those links, you can open up free accounts to try it out. And if you switch to the paid subscription account, that will go a long way towards helping the channel. But at least try it out. They're decent tools. All right. And check out the Discord as always.
So the one that he's got.
What's that?
Do you see Luis's joke with his super chats? It's all the way up. Yeah.
Oh, I didn't actually. Let's see here. Why does Superman only trade Bitcoin during the day? Because he hates kryptonite. Wow. That is tremendous. Luis, hats off to you. Not only for throwing some dollars at us, but for that tremendous joke. I should have my soundboard up so I could play some claps or something, because that's just tremendous. Thank you, Luis. And we have a bunch of highs in the chat. We appreciate it. All right. How's everyone doing in a otherwise red market?
Yeah, pretty good.
Fantastic. Discounts everywhere, right?
You got to love it.
It sounds like, Tom, you got a great idea, huh? You weren't here last week, so we got to shake you down for yours right now. You got a great idea for us? A best idea? Doesn't mean it's great. It just means best.
Yeah, I specifically commented that before we went live, that best idea doesn't equal good idea.
Always so, yeah, disclaimer.
I've got an idea. It's not something I've invested in yet, and yeah, it's Thor money, exactly. It's not something I've invested in yet, and it's a little bit of a different type of investment, I guess, for me, because it's actually a basket bet rather than a specific kind of individual company, and it's basically a basket bet on oil stocks. It's kind of something I've been thinking about. We've seen Buffett put a lot of money into a couple of different oil companies this year with Chevron and Occidental, and he's also got warrants and preferred stock with Oxy as well. And I made a video on this recently, but it seems like there's sort of some interesting like structural things in place with oil supply and oil demand, which seems like it should lead to higher oil prices over time. If I had to guess, I think that's probably one of the main reasons why Buffett's invested in some of these companies. If you look back at what he said in the past, he's basically said that buying a big oil stock is essentially an investment that's heavily dependent on the price of oil, as with the price of a commodity in any commodity company.
So
And the other thing
what are some of those factors before you get to the other one? What are some of those factors that you think would drive it?
Yeah, sure. I guess on the demand side, obviously there's a lot of talk and a few interesting actions in terms of innovation and sustainability initiatives and electric vehicles and renewable energy and all that sort of stuff. But if you look at the kind of hard data, like global oil demand is steadily trucking upwards a couple of % a year, something in that range if you kind of look at the numbers. And even through COVID, where we more or less stopped flying and sent a lot of people into lockdowns and stuff, I think global oil demand in 2020 was only down like 8 or 9% or something from 2019, and it's since returned to new highs. So that's what it looks like on the demand side. On the supply side, I think there's a couple of things in place. Like we've got most of the major oil companies really not that focused on growth and oil exploration anymore. If you listen to any of the conference calls, Oxy and Chevron are actually good examples. They're basically talking about like maintenance, capital expenditure, and buybacks, dividends, and debt repayment. So, and that seems to be a pretty consistent theme across the board, which kind of leads to less new supply, but you've still got growing demand. And then in certain parts of the world, you've also got like government regulation trying to push people towards more sustainable forms of energy. And that's not exactly a positive thing for oil supply either. So I think those are a couple of the structural things that are sort of in place.
I don't know, Tom. Sounds like a macro bet. Are we macro investors now?
I don't think so. Like again, all of this stuff doesn't really make sense unless the price of different oil companies looks attractive. So if you get into the micro, you can start kind of running various oil companies through different scenarios. And it seems like for most of the ones I've looked at to be at, historically average kind of multiples of earnings and cash flow, it kind of implies like maybe something like $60 oil. We were north of $100 oil recently. So you don't have to work that hard to still get interesting returns, even if oil prices do come down a little bit and, your giant macro calls are not all that correct. So
sure.
That's something worth noting. And I mean, since there's been like, even if this turns out to be quite a short-term period of really high oil prices, a lot of these companies have paid off a huge amount of debt and have way more cash than they have in the past as well. And a lot of them also have fewer shares outstanding. So even if you do get back to lower, oil prices in the long run, these companies are in a lot better position than they were beforehand.
So Tom, have you added any in your portfolio at the moment? Or
what was that, sorry?
Have you added any companies in your portfolio?
I haven't bought any. I haven't bought any so far. It's just something I'm still thinking about.
You mentioned there was another that was kind of the first factor, though, was the supply demand kind of macro dynamics. What was the other point you were going to say before I cut you off the first time?
Yeah, I think if I were to guess what someone like Buffett's thinking about, I think the supply demand is one of them, because he said that buying oil stocks is a long-term bet on oil prices. And the other thing I think he really likes is just the capital returns, and that no one's really investing in growth. You're getting a lot back through buybacks and dividends. And if you look at like the most recent cycle of high oil prices, it was exactly the opposite. These oil companies were trying to expand and grow production as much as possible, and you're just not seeing that anymore. It seems like investors want the cash back, and to a certain extent, investors wanting the cash back and these oil companies not wanting to grow kind of reinforces the first point of possibly higher oil prices in the long term. So
if you are thinking about a basket bet, I guess, how would you structure something like that if you were to go ahead? How many companies? What kind of position sizing? Then I guess if you have any in mind, is there specific oil companies that would go into that basket?
Yeah, sure. I don't know. I'm kind of thinking of something like a 5% position in the portfolio for the full basket, and within that, I don't know, maybe 5, 6, 7 companies, something like that. it would be probably reasonably quantitative, where I'm just looking at what the cash flows are, and the only qualitative thing I'd really be looking at would be the capital allocation. So I'd want to see a lot of that being funneled towards buybacks, dividends, maybe a bit of debt repayment as well.
What about the low-cost producer advantage? Is that something you'd look for? Or?
Yeah, I mean, if you look through like an Occidental investor presentation, they've said that they can still pay their quarterly dividend at $40 oil, I think. So that sort of implies that they've got reasonably low cost to be able to do that. I think yes and no. Like, it's quite interesting. If you were to purely be like speculating in random commodity stocks, you'd almost want to pick the highest cost producer if you think oil prices are going to go up, because they're going to have the greatest like percentage gain in earnings if things get a lot better, whereas the low cost producer will actually have a more modest gain. So that sounds a little counterintuitive, but
you got to protect that downside, though.
That's just how the maths works out. Yeah. So I'd be trying to get into companies that don't go bankrupt with lower oil prices. I'll put it that way. So cost of production definitely comes into play, but also just the amount of leverage and so on that they've got to.
I guess just to add to, since we are doing best ideas, one oil company that has interested me slightly, but out of my circle of competence probably. If anyone follows Josh Young on Twitter, he runs a firm called, I think, Bison Capital or Bison something or other, and it's strictly oil and gas focused. He's probably the go-to guy in the industry, definitely an expert in the field. And recently on the Micro Cap Club Best Ideas, or whatever they call their series, he pitched a company called Journey Energy, which is like a $300 million Canadian company that are doing something a little bit different. I know you mentioned earlier a lot of companies, the oil and gas companies, are just buying back shares or paying a dividend. They're actually a bit of a roll-up, acquiring companies. They are paying off a lot of debt, expecting to be debt-free next year and producing a lot more cash flow than ever before. And just on the price of oil, Josh Young, if you're going to take his word for it, and I guess I don't know anyone better to look to, he expects around the $80 to $85 range for the foreseeable future.
Yeah. Josh Young's actually one of the main guys I've been getting companies to add to the list of stuff to look at. So I probably can't speak that accurately to the micro on a lot of these things, but just companies I've got on the list of kind of stuff to look at the moment was Journey, Sandridge Energy, Batex Energy, Vermilion, Meg Energy Corp, and then I know Jason, I think I saw him in the chat before, is a big fan of Ring Energy and Pedevco. So those are a couple more. And I'll probably look a little closer at Oxy and Chevron as well, although I expect it'll be easy to find cheap stuff in the smaller companies. So yeah, that's my mediocre idea for the quarter.
So Josh also has that podcast, right, that he's done with the Investors podcast recently. I think it was like a few months back. Yep. It's a very good resource. Someone's interested in oil companies.
Yeah, for sure.
He's made a few good appearances on a couple of podcasts. If you just search his name in podcasts, there's a couple that pop up, and they're all good if you're interested in oil and gas.
Does he put up like his own write-ups on his website, or is it only on podcasts?
He does a lot on Twitter, but no, I think mostly he just covers stuff here and there at presentations. I think he did say there's some disclosure problems with his fund and what they're allowed to put out there. But yeah, the only real pitch I've seen is the Journey Energy for Microcap Club. Maybe that's wrong though, Tom, if you've come across anything.
Yeah, I've only heard detailed stuff on podcast, I must say.
Are there other people on FinTwit that you guys have come across who are kind of like a good resource for oil and gas and that space?
Copy is a good one. H Copy is the thing. I'm blanking on his name right now. He's a really kind of special situation guy, I guess. And at the moment, he's looking at event-driven stuff. Is probably more of his focus. And oil and gas is definitely something he pays a lot of attention to. So,
is that Jeremy?
That's another one. No. H Copy, Harrison Copy, I think it is.
H Copy. Okay.
Yeah, Jeremy's good as well, though. He's probably in commodities more generally, and a lot down under. If you're interested in things on the ASX as well.
How close are you to pulling the trigger, if at all?
I'm still a little while away, I think.
Sure.
Yeah, I need to get into actually figuring out some of the numbers at the individual company level.
You just got through banks, so you gotta back out a bit and start over.
yeah. I'm much closer to buying a bank that's been talked about here before, but yeah, we'll leave that for
Tom,
another
would you
day.
consider an ETF or something like?
Yeah,
in
I've
that?
been looking. I have been looking at that. Yeah, I'm not sure. I think if I found like a small and micro oil ETF or something, might be a good way to go. But at the same time, I want to also select companies that have good capital allocation policies. Yeah, so not too sure yet.
Do you know about the whole carbon capture thing that Oxy's been investing in? Because it's a space again that I don't know a lot about, but carbon capture is like a thing I keep hearing about all the time. It's something that all these companies are investing a lot of money into. Potentially why Buffett also might be interested specifically in Oxy. Do you know about that?
Don't know a lot about it. I suspect it's pretty minor in the grand scheme of Occidental personally, but I'm not sure.
Okay.
Yeah.
Cool. Okay. Should I get into another? Did we just block someone?
I did.
Yeah.
Yes,
We're getting
and
a few
then-
dodgy comments.
Yes. We're getting big enough to where spam bots are becoming more frequent. Thankfully, not frequent yet, but oh well.
Is this how we know we've made it? Like,
Yes, we've made it.
the bots come.
It's been a joke for a while that like as soon as like you get the first Instagram like copycat account pretending to be you, like that means you've made it. So we've been saying that whenever that happens. It's a shame. Shame to all those bots out there. Anyways, is that a good break point for any more thoughts on oil? It's an interesting idea because I mean you see how much money Buffett in particular and others are pouring into it. So obviously there's something there. But yeah, there is a bit of a hurdle to get over.
Yeah, I mean, I've be worth pulling up their 13F because it's pretty high up their like list of US holdings at this point.
Yeah, it's very high. It's just keep
I
pouring
mean,
billions after
yeah.
billions.
Yeah, Chevron is now the 4th biggest position, and Oxy's number 6. So
I feel like Buffett's formed the floor for Oxy's. Like you see it below 60, you know he's buying at this point.
yeah, exactly. Yeah,
He's formed that floor.
if you combine those two stocks together, it would be the 2nd biggest position behind Apple. A fair way behind Apple, but ahead of Bank of America.
And buybacks. I mean, buybacks considered
sure.
it would be like, yeah.
In Berkshire.
Yep.
And I
Have
think
they
he's
been
bought a
buying
lot
that?
more Oxy recently since anything's been updated 13F wise. So
Yeah, I think this includes the Form 4 stuff. But you're right. If you're just purely looking at 13Fs, yeah.
I think he's up to like 26%, right, at this point. 20 plus the warrants.
Yeah, about that. It depends if you include the warrants. I think it's pushing 30 with the warrants at this point.
Is it? Oh, okay.
Yeah.
What are the mechanics of that purchase like on their end? Is it just like, all right, here's our quota for the day to buy? Like, how did they decide? All right, we're going to buy this amount today. Like, what's? I wonder how they actually work through that because it's so many billions they're throwing around.
Yeah, not sure.
So wake up.
It's
and
just
say,
got that one guy that does it though, right?
Yeah, is it one guy? Is it like all right?
It is one guy.
No,
It is
but,
one guy. We know that.
But like it flows through some sort of approval. I'm sure. Obviously one guy's making the trade, but yeah.
I picture Warren turning up with his McDonald's in the morning
Yeah,
in the office and just going, this many billion at this
Yeah.
price.
What's my allowance today? 1.5 billion or something like that.
Exactly. Yeah, or it seems like he actually talked a bit about that of the back in the day Coca-Cola purchases. And I think he was just telling his broker, like, buy a third of the volume every day, and we'll tell you when to stop. I think that's how they were doing it.
It's a different league.
Yeah.
I wonder if there's a buyout in the, future. Potentially.
For Oxy.
Or is it- yeah.
Yeah.
it
Well,
does
they've got
seem
approval
a bit
to
of
buy
a public
50%.
takeover.
I was about to say it's not really their style, but they did just recently buy full energy assets. Or they've done it before, so could be.
Berkshire have
Yeah, like with
Berkshire Hathaway Energy.
yeah, yeah, right, exactly. They absorb. They do a lot more absorbing into that than say like, if they had the money, I don't think they would buy 100% of Apple, but because they like that passive sort of ride with the wonderful company, let them run it. But I think on the energy side, it might be a bit different, a little bit more active.
I think they'd buy Apple if it was smaller.
Really, the whole thing?
Yeah, why not?
Well, I don't know. Again, I don't think it's their style. But I don't know. Maybe it's hypothetical. So
It'd leave Tim Apple there, and
yeah, right.
let him do his thing.
Right.
On the topic of, sorry, Karan, I'm delaying your idea here, but on the
Go
topic
for
of
it.
Berkshire, did you guys see that Greg Abel bought like 60 million of Berkshire stock?
Yeah.
That's pretty
Crazy.
that's some serious insider buying. You don't see that very often.
That's a swing.
Yeah. Yeah.
guys
I mean,
know
I'm
what
pretty
his
sure
average
he's close
price
to a
was?
billionaire, but
Do you know what his average price was? I think 400-ish or 410.
I can find it. One sec. Yeah, so he bought at between 405,000 and 408,000. So it was all A shares. He went from owning 5 A shares to 173.
Modest increase.
Yep. Anyway, what do you got, Karan?
I hear Louis saying BRK is my best idea. I'm gonna tell him like, don't do that. Don't say that over here because you get a lot of shit for it.
You'll anger the people.
You'll anger the crowd. Yeah.
You'll anger the trolls.
Yeah. So again, not best idea, just an idea. So we know what's happening with Seritage, right? Like the whole disposal, everything suddenly shot up. Now it's crashed recently because of Eddie disclosing that he sold off his position. Guys, just 1 second. Back, I think.
Pulling up the SRG chart and they're on ticker. And
Typical
let's-
Quran getting out of his best idea.
Sorry, what was that?
we were making fun of you.
Was that a margin call?
Of course, yeah. I mentioned SRG and margin calls just go off.
Just messing with you.
Yeah, they're down to $8.31 per share after being over 14 back in August. A pretty sharp drop very recently.
So reasonably, the company has come out and said that, it's between $18.5 to around $23 per share, is it? Or is it 20?
Yeah.
1850 to 29 is the original range.
1850 to 29.
They've come out with a further update saying the top end of the range is probably unlikely, but that's where it's at.
Yeah, so conservatively assuming 23, but I don't think suppose you don't even get to 18. Suppose you get to a value of 15 for all the assets net of debt. What I'm looking at is the leaps that are available. I think the leaps offer a pretty decent return. Not buying the shares, because the shares, of course, from 8 to 15, 16 on a time frame might not be as much of an attractive return. But if you were to look at the leaps, they're pretty attractively priced. Although the spread between the bid and ask is kind of ridiculous, but it's still a pretty interesting sort of idea that someone could dig into.
Weren't you in their leaps pretty recently? Or are you still in them?
No, so I got into the leaps when it was around $5 per share.
Mm-hmm.
And I bought into the strike of around 8 and 12 and $15. And I completely exited the position once, I think it had close to $13 per share.
Hey,
So-
Karan, Eunice is asking, can someone explain what LEAPS are? So LEAPS is an acronym. I'll let you take it from there.
Sure, yeah. So LEAPs are long-term equity anticipation securities. And the entire idea is to basically, you have a contract, right, that's exchange traded. And it matures at a certain date and at a certain price. So you buy at a certain strike price And in order to buy into these leaps, you pay a certain premium. So that's pretty much what you can see if you look at like an option chart on any broker. I really forgot. Like I felt like we have to explain leaps. I wasn't.
It's hard when you don't understand options in general. It's the right to buy something at a certain price or sell something depending on what you're doing.
And in this context, it's like a way to get a really leveraged and or zero return, depending on like what the
because each contract gives you the right to buy or sell 100 shares. So you're buying one contract for technically control over 100 shares. That's where like the leverage element comes in. But if it doesn't reach that price or falls out of the money, then you're left with nothing if you let it expire. So that's the risk. Because there's time value baked in here. If you reach the date and it's not at that price, and you're in trouble. So that's the big risk with options.
Yeah. So as a value play, the best thing to do is kind of go as deep in the money. So which is basically having the strike price as low as possible relative to the existing stock price. So Seritage right now is like at around $8 per share. You can look at the strikes of 5 or even 8. 5 is kind of the most attractively priced. And go for the 2025 leap. So you have like around 825 days remaining until that contract expires. And this is with the expectation that, Seritage kind of winds up before that date. So that's kind of the risk that you have here.
So I'm admittedly, I don't really understand options too well. It's not something I've ever looked at and not too interested in really, but what's worst case scenario on SRG leaps?
So the value goes to zero with the $5 strikes. So the bid is like, I'm checking it here, it's like 3.6 to 5.9. So the spread is huge. What you can do is kind of find a reasonable price and then make your net effective price be like 5 plus the premium, which is like, say, $4 per share. So your net effective price becomes 9 at that point, right? So if you were to exercise these options, you've paid the premium of roughly $4 per share, plus you have the strike price of 5. We expect Seritage to be at, say, 15, right, on a extremely like bearish scenario. And that's before 2025. So basically you get that spread that's there as the profit between your premium and the stock price at that point.
Yeah,
I've done a terrible job explaining these, haven't
I? that was pretty good.
Okay.
It's hard without concrete examples, but that's
hard without the graph and actually
with graphs.
Yeah, explaining the
you can look at things. You can look at things. There's like I think it's like stockoptionscalculator.com or something like that, and it will totally illustrate a lot of like how much money you would make if something expired that day based on what you paid for it. And so that's how that helped me get comfortable with how kind of options work. So I'd recommend if anyone's interested, check that stuff out. There's plenty of good.
There's a
resources.
website that I use. I can share it in the chat. It's called Options Profit Calculator, but
that's what I'm talking about. Yeah, Options Profit Calculator. It's like the first result, right? It gives you like a chart.
Yeah, it's easy to understand. Just should we open it up and so people can?
I'll pull it up.
I mean the underlying fundamentals of Seritage is still what matter at the end of the day. It's just
correct.
Your risk reward looks very different between the leaps and the stock as well.
Yeah.
I think
one of the other large risks that you have with the leaps is that in the event that Seritage decides to issue dividends rather than doing something else, after paying off the debt, if they say we're going to issue dividends and you're holding leaps, in that scenario, you will not get the dividend unless you exercise the leap and take the shares, basically. So you have to be holding shares in order to receive that dividend. So that's another risk that may come up. Another risk with the leaps is that the liquidity is pretty low. So you have like around 100, 200 contracts trading at any given time. So if you've got like a larger amount that you're investing or using for these leaps, you might struggle to exit the position at some point. So again, you'd probably have to exercise and then sell the shares at that point. So,
okay, here I tried to pull up the the exact example, the $5 strike. Let's see, share the screen.
Yeah.
So using optionsprofitcalculator.com, we input the ticker symbol, SRG. It takes, I think, the latest close price or something like that. You can adjust this. But I did the January 2025 $5 call option. So the $5 strike price, which is trading for $475 per contract.
Which, if you multiply that by like the max quantity that you have available over there is like around 200. Yeah.
And
So
then
say 100.
and then it spits out this chart here that shows you your profit or loss based on what would happen if it expired. So the furthest right column is the expiration date of January 2025.
Jack, for the prices, could you put it as like maybe 15 to 20? That would give a more accurate representation of.
Well, I still want to show what happens if it's under that.
Yeah.
So let's say it closes at $4 in January 2025. You still have this option contract. That would mean you lost all of your money. You lost 100%. The $475 that you paid, you lose it all because it expired out of the money. And it's in the money once you get over 5. But you're still losing money here, even though it's in the money still, because you had to pay all this money to pay for the contract in the first place. So you're still losing money until you get up to, like what Karan was saying, around $9, which is up here. So your break even's between $9.50 and $10. That's where you need it to get to by expiration just to be profitable. But if it goes all the way, say, to 15, now you're making double your money, even though the stock less than doubled, if you want to look at it that way. But but this is all the way to expiration. And as you can see, because there's time value in these options, you'll typically have a bit more value left over if it reaches that price prior to expiration. You can see like that the profit increases the earlier that happens. Granted, things can change. This isn't science because there's feelings involved, just like with stocks, so that can change the option price. But if you go to expiration, this will be the value of the option, generally speaking.
Absolutely. So, and even if you're buying 100 shares of Seritage, for example, at this price, you're paying $800, right? $813. But with one contract, you get the same sort of exposure for like $475. So significantly lower than your upfront, your upfront capital investment is a lot lower than what you would have as opposed to just buying normal shares. So,
does that answer? Does this crash course answer anything?
should we try it with the like more reasonable numbers, 15 to 20, because that actually is where we're expecting Seritage to roughly land at.
Reasonable to some, but sure. We'll say 15 to 20.
29.
Yeah, sure. 29. The pie in the sky scenario.
Yeah, sure.
I'd say is unlikely. Now, if it gets to that, you're making a lot. Let's say if it reached 29 somehow, you're 4xing your money. Whereas if it gets up to say 20, you are just over doubling your money, or just about doubling your money.
Yeah, and another thing, like you don't want to hold an option all the way to expiry.
Right.
Ideally, you want to sell it out as quickly as possible, right? Like you mentioned earlier, the earlier you sell it off, like the higher the profit that you can earn on it. So
because of the time value baked in.
Because of time decay. Yes.
Time decay, right?
So ideally, you start seeing the real effects of time decay close to like 120, 100 days towards expiry. That's when you really see the drop off, even in the graphs, or even here. That's when you kind of start seeing the effect of time decay.
Yeah, it accelerates in those last few months, like you were saying. That's the appeal of like the long dated options, because there's not a whole lot of decay in the first half, whereas in the second half there'd be a lot more.
Also, like we should definitely tell people there's a lot more risk to options, like liquidity, like losing all your money. All that can happen. So yeah, I mean, best to avoid it. But if you're doing it, just to learn, try it out. Yeah, if you want.
The other thing I was just going to add a couple things quickly on Seritage more generally, Karan. There's a really good account, a guy called David Maradi. He's at DM10011 on Twitter. So he's been tracking quite closely like what properties have been dropping off Seritage's website, which we're interpreting to mean Seritage have sold them and don't own them anymore and now have cash. And apparently they're down to 116 properties now versus 150 at the end of June. So even pre-shareholder vote here, they're clearing properties pretty quickly, it looks like. And the annual meeting for Seritage is on Monday, the 24th of October. So not too far away. We should see if the liquidation, thing's gonna become official.
It's one I'm actually increasingly interested once again now that it's backed by 8, because I have that Equity Commonwealth share or Equity Commonwealth position that's a big portion of my portfolio, which is effectively a cash pile that may be used in real estate, whereas SRG is becoming a cash pile that was invested in real estate. So it's like they're getting to the same. They're trying to get to the same point in a weird way. But yeah, the fact that they're offloading a lot of these properties, every property they sell is less risk, as long as it's sold at a decent price, of course. So it makes it increasingly attractive since there's more certainty.
Yeah, the next like 1 or 2 quarters of data out of SRG's 10Q and stuff will be super interesting to see what they're getting paid for these things.
Right.
So far, I think it's like around the estimates that you had, right, Tom? Or is that?
Yeah, I'm hesitant to put much out there on that just because the number of properties sold last quarter was pretty small. But I'll probably do a proper run through of the portfolio again next time they report, and we'll see. Yeah, the ones I've seen have been roughly in line, but I was coming out with higher than $29 a share, so I've probably been too optimistic on some.
We've had we haven't had massive drops in real estate prices yet. They could be coming, and there has been some skittishness increasingingly. So, but it's not like we would be seeing they're selling for half what you estimated probably yet. It could always change.
Yeah, I'm not sure if it was again David on Twitter, if it was someone else, but someone's shared some Crexi cap rate data.
That was David
yesterday. That was David. Okay,
yeah.
And it seems like cap rates have been pretty much flat this year, which kind of surprised me actually.
Yeah.
Yeah.
Still a lot of money swimming.
That feel right to you, Jake?
There's still a lot of money swimming around. I was working on a deal. I forget if I mentioned it on the show, but I was working on a pretty big deal on an industrial property. Industrial's been so hot all year and really for years now that fell through at the last second. So they were trying to get this deal done by the end of the quarter. The end of the quarter arrived, and they decided even then that they didn't want to go through with it. But I don't know if that deal is ever going to rematerialize or not. But as the first deal I've actually worked on that fell through after any significant work had been done already, which it's cause for concern. But we'll see what's happening. I think they're a little concerned about interest rates rising, as many investors are. But we shall see. I wouldn't expect like an incredible drop off anytime soon, but it could always happen, and you could see some like slight pullbacks in the meantime, though not yet.
Jack, how is it sustainable? Like when mortgage rates go from like
it's not
2.9 7, like
it's
how,
not.
I mean,
well, the only thing I think one of the major things, this is more of a theory. One of the major things that props up, especially larger commercial deals, are taxes, because in the U.S., at whatever price you buy the property at, you can still effectively buy a tax deduction. So it can actually make sense to overpay for a property in many cases, where you might be making a 3 or 4% cap rate on it for the foreseeable future, but you get a massive tax write-off in the first year that saves you, 25% taxes on some other portion of your income. Then it makes sense to overpay for that property because you're making that money back as a tax write-off in a weird way. And then you just kind of keep the 3 to 4% yield after that to pay your pensioners or whatever. So it can make sense at the big level like that to what a smaller investor might consider overpaying for the property, because they're not really buying the property, they're buying the tax write-off. That's a theory I have. That's the reason I think a lot of larger funds are doing that sort of stuff. And then, of course, there's always speculation that rents are going to rise, that an area is going to be more desirable, which certainly can happen at the local level. But at the aggregate, I think it's a pretty big reason we're seeing so much, quote, overpaying for properties from like a yield basis.
Real estate only goes up, bro.
Yeah, of course. It's more like the dollar always goes down, except for the last 2 months. The dollar always goes down, so compared to real estate. So, because the real estate, it's the same amount of housing, it's the same amount of space as before. So it's not like it intrinsically more valuable. But when you add leverage and then currency devaluation, you get wonderful things over 40 years. So that's really kind of what it is. Here comes another spammer.
Yeah, I know.
I think
Save that link.
In Australia, we've seen like just home prices go to the right, like for 20 years now at this point.
Yeah, 30 years. It's been the interest rate cycle, but now we're kind of getting towards what seems like the end. Lazy investor, I just got to say, it says to that spam, the OG pump and dump right there. It was a very risque link. So for those of you listening via podcast, which by the way, we have a podcast. We get a few downloads every week, more than a few now. So if you guys prefer the podcast method, we'd love to see you guys here on the YouTube live chat. But we do have the podcast version if you're watching after the show. We try to post it the day after these live episodes. So that is an option now. We're trying to slowly post all of our old episodes on there too. If you're newer to the show and you want to go back and check out some of the old stuff, which whatever suits your fancy. Where were we? Real estate, SRG, cap rates,
Super chat
from a very aptly named Investing in Stocks for the Long Term. That is the name of this guy's account. I appreciate that. He says PBI, it's a legacy biz with a lot of free cash flow. E-commerce may turn in Q4.
Is Pitney Bowes the company that's written about in Good to Great? Is that one of those businesses? Have any of you guys read Good to Great?
I actually just bought it. I just bought the book. So it's on my desk.
I'm not sure.
Yeah, don't know a lot about this one.
He says yes, it is. Any thoughts? We could take a quick look. 500 million market cap with a fairly stagnant top line, 3.3 billion. Gross margin's pretty stable, around 30%. 500 million in cash, short-term investments. 2 billion in long-term debt. That's a lot of debt. Shares are slowly going down, though they have ticked up, I guess, in the last couple of years. Cash flow, a little weak on the last 12 months, only 40 million, or is that 40 million? Yeah, 40, right? $40 million in free cash flow versus about 120 last year versus 200 the year before that. So not a great trend there on the free cash flow side of things. That's a lot of debt. And then ratios here.
It's a big boy super chat from David.
I'm on a different tab. I'll have to get to it in a second. But that's Pitney Bowes. Any thoughts? Just looking at the quick numbers there. It's a lot of debt for only a $500 million market cap and not a lot of cash.
Yeah. I think this is another one of those ones that's going to be pretty hard to tell just by looking at the.
Yeah, I don't know what's.
Yeah,
I don't know what's going on with it. What's coming up next? They have some plan or no plan? Like what's going on? I'm not too sure, but that's the general overview.
Yeah,
it's in good to great though, so we're told.
Yeah.
And then here's David, just buying a beer for Frank, 10 New Zealand dollars, not even Australian dollars, New Zealand dollars. But
What a legend. I had to check. I did the conversion to make sure it's actually enough to afford a beer, and it is. It's about $8 Australian. We pay about
Fantastic.
$7 for a schooner, so
how generous.
Schooner. Jack, do you know what a schooner is?
I'm assuming it's a pack or something, or a pack of cheap beer. What is that?
I had
don't know.
no idea what a schooner was the first
Yeah.
time I went.
Is
to
that
it.
Australia has its own like different English, like just the slang is a
I
bit
didn't-
different.
I didn't know that was an Australian thing until right now.
Definitely Australian.
What is it?
Well, I actually don't know what the equivalent would be. It's not a pint. What's a pint to you?
It's like a small glass, right? No?
Well, it's a pretty
Yeah.
big glass. It's like
You know,
a.
people say pint, but it's kind of rare.
If you order a beer off a tap at a bar, what do you call it?
Yeah.
See, that's a problem. I don't do that. I don't drink. I asked for a glass of water.
I don't know.
Look, I don't know, man.
Fine.
Google tells me it's 420 mils, if that's any reference.
All right, so a schooner is a pint of beer. So we're told.
It's
Yeah,
a smaller than
that's
a pint in
14.3 fluid
Australia.
ounces.
A pint in
A
Australia
pint where
is
the
a
bartender
big
has a
schooner.
sip and gives it to you. Is that it?
A small beer.
Tap beer in a glass. That's the best I've got for you.
Okay, great.
Yeah. Slightly
you
more
know.
volume than that bottle you've got. Is that right, Frank?
Yeah, it would be. Yeah,
Yeah. There we go.
it's this 330. So yeah,
And then Jonathan, he gave us a super chat as well. We got they're flooding in, trying to get us to Omaha for next year. He says he'll lay off the VOO comments. Jonathan's a resident index fund guy who always shows up to our live streams, which we very much appreciate. Markle deserves consideration as a long-term ownership. Sure.
Didn't we do an episode on that? I'm sure we did a mini
Yeah,
Berkshires
wasn't it?
episode.
Yeah, it was the mini Berkshires
Buffett.
episode.
Mini Berkshires. Mini Buffets.
Yeah. Mini Buffets. Aren't they at 10 cent? Someone said.
Tom, you still have the bobbleheads. Was it the bobbleheads that you had at the back? You still have those?
Let's
there's
go.
a mini Buffett.
No, that's Charlie.
That's
Come on,
Charlie.
guys.
And he's got his
We
wall. He's got
got
his
Warren.
flex wall behind us too. Of him with cool investors.
Yeah, sorry.
You should put it. You should actually frame it, like space it out so it's like around your head, like because right now it's behind you. You got to
Yeah.
space it out so there's a gap in between the pictures for your head for camera time.
Right. Okay. Maybe I'll put a really big one just in that.
Oh, get a cutout.
Area.
Get a cutout.
You can have
Charlie-
the Mount Rushmore.
No, just get a straight up cutout, like a life-size cutout of like Charlie or Warren, and put them there.
What if I get several cutouts, one for each of the punch card members, and each week I'll have a different. I'll have
you
Jack
rotate
back there
it.
1 week.
I
and
was
then
going
I'll
to
have
suggest
Brad.
rotating. You have Charlie and Warren, but actually just get our crew in. That's even better.
Yeah. There you go.
We got yet
Another
another
super chat.
with these super chats,
Yeah.
guys.
I think we need to stop whoring ourselves out for ticker times.
Thoughts on DNMR? What is that? David Einhorn stock. This is from Janaka.
NMR
DNMR.
Scientific.
I feel like we saw this name once and just kind of brushed over it. I forget what it
The
was.
description is where I pass.
Yeah, right. But this sounds familiar, probably because it's an Einhorn stock.
It passes the ARC test, growing revenue 20% and growing shares out 200%.
Something tells me it was on ARC, but I don't think so. Our ARC breakdown. Yeah, big revenue growth. Though not so much in the last 12. Last 12 months are
Continuously getting less profitable. As
Gross
it grows.
profit down 80%. Is that good?
yeah, and now a net loss on a gross profit basis. 140 million in cash, 260 million in debt, long-term debt, negative net income, negative cash from operations.
Kind of one where the numbers aren't going to tell us too much. It
Yeah,
clearly
no.
looks like a poor performing stock, but if there's more to it, there's more to it. But
Yeah.
Yeah.
Deeply negative free cash flow, probably because they're investing a bunch into something. Yeah, 240 million in capital expenditure. I don't know towards what in the last 12 months. But they develop and produce bioplastic replacements for traditional petroleum-based plastics. So if that's your wheelhouse, we might have a stock for you. DNMR, bioplastics.
Yeah, too hard.
But thank you, Janaka, for the super chat. And then we have another one from just to clarify on Pitney Bowes investing in stocks for the long term. The user says $1 billion in Pitney Bowes debt is from their own bank. That's still a lot of debt, though. That still leaves like $1 billion in debt, right?
So they can't default on themselves. Is that what?
Yeah. How does that even work then? If they can't,
No,
if it came
that's
to
a
bank,
spawner, guys.
yeah, spawn their own debt. I don't know what to make of that. Unless there's some special detail that it's not actually debt and it's just debt on their balance sheet. If it came to bankruptcy, that'd be relevant, right? I don't know.
Well, the debt holders just own themselves again, I guess.
Yeah, and only if the shareholders are the same, right? I don't know if they've sold off the bank shares. I guess that's what it would come down to. But even so, it's kind of weird.
Yeah.
That means the bank, and one of them is at risk. Right? Because that means the bank is at risk if the money has been spent. Like someone's got to make it up, right?
I don't know, man.
Yeah, whatever. I do not know the details. I'm just guessing. Matt says Einhorn did a recent interview worth a listen.
Should we do some questions or any other stocks you guys want to talk about?
Yeah, we've been diving into a lot of them.
I'm happy to do a real quick pitch. Given
do
that
it.
we're running out of time.
It's a bonus. Do it.
A bonus. I did do a best ideas last week. If anyone's interested, that's a lot more in depth than this one. But this is my current write up that I'm doing for about 2 weeks' time. It should come out on One Water Marine. Ticker is ONEW. Small cap, semi-liquid kind of stock, I guess. Founder-owner kind of business. Cyclical in nature, I guess, like being in a recession. They sell boats, so most of their business is boat retailing, but they also have insurance and finance and then like parts and services, which helps to kind of smooth out the cyclicality of just selling new and used boats. But new and used boats is still about 60% of revenue off the top of my head, maybe more than that actually.
Sounds like a boat version of Thor.
It kind of is in a way, I guess. A lot of their growth though comes through acquisitions. So
just moving
back to the past 5 years, about half of their revenue growth, or it's actually 53% to be specific, is from acquisitions, and the rest is organic, where they kind of expand their product line. So as they acquire like parts and services businesses as well as finance and insurance, they add that onto each of their existing retailers, which is about 92, maybe more, retailers across 16 or so states. Some of these numbers might be slightly off, but just to give you a bit of a picture.
Sorry, Frank, go ahead.
Go for it. No, go for it.
I was just going to say these guys are a retailer rather than like they're not making boats, right?
They
had
do
60% gross margins or something. That can't be a boat.
Yeah, they're
builder,
not.
surely.
They're mostly retailers. They do have like a few distribution kind of centers. I'm not sure if they own an actual manufacturer outright, but they
So not like Thor.
they do. They're mostly on the retail end, which is why it's a lot easier to grow, I think, through acquisition, as they can just roll up a very fragmented industry. Typical of any acquirer that I like to look at. It needs to go with a fragmented industry, otherwise they're just lacking opportunities. And one what I would call a programmatic acquirer, which is defined as making at least 2 acquisitions on average over the past 5 years, which they will and truly do that. But yeah, that's pretty much the thesis in a nutshell. They trade at about 4 times EBITDA. When they acquire a company, they're pretty much paying 2 times EBITDA. But that's after like post synergy, so they aim to pay less than 4 times. But then they double the profit margins after making the acquisition through some of their advantages they can offer.
Now having that back KPG.
Yeah, it does.
There's a common theme with some of these pitches.
What's the story with all the share count growth, Frank? Are they just paying with stock for these acquisitions? Or
yeah, right. I was thinking the same.
Now they pretty much fund strictly through free cash flow and debt.
The debt has gone up quite a bit,
which is why the debt's grown so fast.
Yep.
Some of the dilution you might be seeing is from the listing, which was 2020 from memory.
Yeah, it was like 2,000% or something.
Yeah, they've tripled debt. They've tripled debt in the last 12 months, and then shares have grown like 40% in 2 years.
Yeah, so the 2 years that's just since being listed.
Right.
But now they're buying back shares, so share count will very likely reduce moving forward. But they're more focused on acquisitions rather than, more focused on acquisitions to grow than anything else. And organic kind of comes with that. The more acquisitions they make, the more it helps organic growth, just because of the different options that they can add to their existing businesses.
All right,
cool. Do you know what they're actually doing to like? I don't know. Am I thinking about this the right way, that they're similar in nature to like a car dealership type business here, where they have like a servicing component and a retailing component? I'm just wondering, like, how do you actually get such a good margin increase in that sort of business?
I guess it's not too dissimilar than to a car dealership, but I think the industry is very different. Obviously, even just being a regional business changes a lot of different factors, and it's more of a what's the word I'm looking for? It's not a purchase that everyone has to make. It's more of a joy purchase, I guess, which is probably affected even more so in a recession. But again, I think by having like the full kind of life cycle of a boat, the parts and services, insurance, finance, all of those things, that helps get through some of the cyclical aspects. And it's also a lot of operating leverage they've seen. So margins have gone from about 4% on the bottom line to about 9%. That might be slightly off if you want to check, but in 5 years, they've pretty much doubled margins.
Yeah, looks like they've got pretty steadily increasing gross margins. So
a lot of their gross. So talking about that finance and insurance, as well as parts and services aspect of the business, makes the gross margins look better. Although most revenue comes from the used and new sale boats, more of the gross profit, or closer to half, comes from the other aspects of the business, which are higher margin businesses.
Cool.
All right.
But yeah, more to come on that one. I'm still doing work on that one, but it's definitely very interesting to me.
It fits the mold.
How were you able to find the idea? Like, did you get it on Screener, or did you hear about it?
You bought a boat.
I wish. No, this one was I think I would have found on a Twitter idea, actually. A couple of people I follow on Twitter have talked about this one here and there. And it's not as illiquid as usual. Maybe 500 million. Maybe I'm a bit off on that. 500 million market cap or so.
Yeah.
So it's not as small and illiquid. There is a bit of coverage and a bit of analysts that do follow this one. So
nice.
Did we mention Prem? Sorry.
Yeah. Go ahead, Karan.
Yeah. Have we seen any like change within the management, or is it pretty much the same management that's been there throughout? Or?
Founder still there, owns, I want to say 10%, a significant amount of shares, and a few of the other insiders own a fair bit as well. So, and they're very confident in the business too. They really aren't concerned about recession. which maybe is a bit of them a marketing side. I don't know, but they seem very confident that they're just going to continue making acquisitions in this environment, and that it creates more of an opportunity for them. But that's to be decided, I guess.
All right, shall we wrap up with Prem's super chat from a little while ago for UNH stock? What is that?
United Health. Is it?
Berkshire Hathaway.
Is United Health. Whoa, look at that, a green stock up in the last year. Overview. That is a fat market cap, 500 billion. Yeah, 500 billion. Right? No. Yes. Help me, guys. Is that a 500 billion market cap?
I think so.
Yeah,
It looks like it, but is that wrong? Why don't we know the company if it's that big?
Because it's healthcare. Diversified healthcare.
What's this thing called? United Healthcare.
United Health. UNH. Diversified
Yeah, that's
healthcare
500
company.
billion. I just
Yeah.
googled it.
it is. Yeah.
What the hell?
I've heard of it before, but I had no idea it was this big. United Healthcare segment offers consumer-oriented health benefit plans and services for national employees, public sector employees, employers in general, insurance plans, the like.
It's also like a 20 bagger since 2009.
I mean, it's up in this market. So what does that tell you? Somehow. Top line has been steadily growing. That is up to about almost over $300 billion in the last 12 months. With they don't have the gross margins here, but operating margins of about 8 to 9% that have been very steady. There's got to be a bunch of debt for sure, right? It's an insurance company.
Part of the business model, I guess.
Let's see, 45 billion in debt versus 40 billion in cash. So not so much, not so bad.
Yeah, but what's that all relative to their equity?
Well, they're like the $500 billion market cap.
No, but what's their debt to equity, for example, if we go to ratios?
Yeah. Where is it?
If
Oh,
we
here it
get
is.
that.
Debt to equity 60%.
Yeah, okay.
That's been pretty steady.
What's their kind of book value or even price to earnings over a long period? Like, are they cheap relative to historically? I guess they're reaching a point where growing is a problem.
Well, what's going on here with?
Are they buying back a lot of
Hey,
stock?
you're not on ratios.
I know.
Not on valuation.
I just switched off, but I just wanted to take a look. Their cash flow has jumped quite a bit in the last 12 months. $30 billion up from 20 a year ago and 20 the year before as well. So I wonder if
Buying
something's
back $7 billion worth of stock and paying out about $5 billion.
Here are your historical multiples.
Yeah, I don't know. It's probably out of my circle of competence to make any real comments, but it's just a very mature business. So to find an edge
It
on this
seems
one, I
like
think
someone
would
who'd be interested in dividends would want to just hold this and just.
sure.
Yeah, 1.3% dividend yield is a start, and you got the buybacks.
Yeah, trades at like 6 times book or something though. It seems expensive-ish for financial.
Financial and healthcare, I guess, if you want to look at it that way. They got our pharmacy segment as well. So there's a lot going on here. It's a huge company.
I'm
Yeah,
just
I don't
You
know if
might
any
wanna
of
do
us are
like a-
insurance experts.
Yeah, you might want to do like a sum of the parts sort of thing here. That's what it seems like.
Seems like an activist target, like down the line. I can see someone coming in saying this part is not valued correctly, doing something.
And what doing a spin-off?
It seems like the type of company that you can hear Carl Icahn like completely take a 5% position.
Yeah, it'd be the only one with enough weight behind him to actually do that. So big.
I wonder who are the top. I'm sure the top owners are all funds, but I wonder.
Vanguard.
Yeah, Vanguard almost. Wow, that's a fat position from Vanguard. Fidelity, State Street, Blackout, T Rowe. It's all funds.
Yeah,
I just can't believe that it's a $500 billion company. I've honestly never heard of it.
I'd only heard of it, never looked into it. Yeah, it is flat out all funds. Yeah, now you're getting into tiny shareholders.
Yeah.
Well, seeing as though we don't have very much to offer,
next time let's look at a schooner company.
Yeah.
We've learned about that.
Now we're talking.
Manu says, amazing moat from UNH.
Sure.
Fair enough. They've
done
something right.
Whatever you say,
I believe it.
They've done something right.
Seems like to get to that size, and of course they do, I guess. But
yeah.
Manu does have a point, though. These kinds of stocks are always seemingly expensive. That might be like the Terry Smith sort of, the wonderful business always seems expensive and then it ends up growing, that sort of thing. It could be, but I don't know enough about it.
I just don't see where that alpha would be in a stock like this, but
yeah,
maybe I'm missing something.
Yeah. All right. Cool. I think that's a good spot to wrap. Well, we had quite the addition to the meetup fund, if that is a thing that we have going on. So we appreciate all the super chats and all the lively conversation. This is one of more lively chats we've had in quite some time. So we appreciate all the engagement, including from the spam bots, one which just showed up again. We got maybe that's what's pumping the engagement, it's making me feel like the chat's been more lively. Just all these bots coming in, but we weeded them out. Anyways, thanks again for stopping by. Please be sure to like, comment, subscribe. It goes a long way towards helping the channel, just like checking out the discount links for Seeking Alpha and to Share Site. Go ahead and check those out. Like I mentioned at the top of the show, check out the Discord. I don't have anything else to add. Till next time, everyone.
Thanks for tuning in to Punch Card Investing. The contents of this show should not be used as investment advice or as a recommendation to invest in a particular security. Please consult with a licensed investment advisor if you need investment advice. All investments carry risk and the potential for monetary loss. Thank you, and see you next week.